Questions?
I have using the new, this particular study based on the '08 returns, '08 happens, so it makes your work look really good. What if '08 doesn't come around anymore? Is the old way better than the new way?
So these charts here go from 99 to 2012. Right, so these are our 3-year rolling correlations, and these are our 3-year rolling standard deviations. So even if you go back pre-08, and you could tell from the chart exactly when '08 is, these issues were still very important. There's an economic reason that the hedge funds are short event risk, and there's an economic reason that the private equity and real estate funds are short liquidity risk. But definitely one thing we could do here is look at before '08 how stark the difference was. It's something we could add to the study.
So you think that with the asymmetric risk characteristics of a lot of hedge funds with their options and option-like strategies that you can really capture the risk with a parametric model like standard deviation and that kind of thing?
Right, so option strategies or something like merger arb that's like an option strategies, structured products, their returns are nonlinear, right, by nature, right? And so I have another paper on VIX, and so the question is, how much volatility risk am I short in these strategies? Right? So if merger arb is a short volatility kind of event risk seeking strategy that gets hurt when equities decline, how much VIX do I need to buy back to make that a normally distributed return? And so if you take 7 parts of the strategy and 1 part of VIX, our returns are normally distributed. You still have a nice positive return. You could return your risk to normal, but what happens is the standard deviation goes way up. So what happens is when you buy back that short volatility risk, what you're doing is you're taking that skewness and kurtosis risk and putting it back into the standard deviation. And standard deviation goes up by maybe a quarter to get the returns to be normally distributed. So what you'd lose on the fat tail on these arbitrage strategies, you make on the fat tail of VIX, which works in the opposite direction.
All right, so interesting approach. So basically, you buy VIX to the point where the distributions are normalized or symmetric.
Right, because VIX works exactly the opposite as the equity market. And so if you're short volatility in your hedge fund program, you could be long volatility in a volatility product to the point where those higher moments exposures offset each other. And then you could quantify exactly what that cost of skewness and kurtosis is in terms of a standard deviation or a Sharpe ratio. Yes?
Are you calculating standard deviation monthly or quarterly, and over what time period? Is it since inception or?
Right, so I'm mixing things up a little bit here. So the hedge fund study on the higher moments is 96 to 2012 with monthly returns. And then when we move into these strategies, by definition, the real estate, private equity, and venture capital are on quarterly returns. Again, this is 96 through 2012. So the starting hedge fund numbers were monthly, and then the ending hedge fund numbers were quarterly, so I could match them up in this framework with the real estate and the private equity.
Do you recommend monthly or quarterly when we're doing it to?
I would always use the most frequent data available.
So monthly.
Monthly if you have it.
And then do you go since inception, or do you go for like a 3-year or 5-year? Like how do you?
Yes. I don't think there's one risk measure, right? I think people who say, 5-year VAR or 5-year standard deviation is the risk measure, right? I think that's a very dangerous approach, right? Let's look at 3-year, 5-year, and since inception. Let's look at scenario analysis. right? What happened in 08? What happened in 98? What happened in 2001, right? And so if we take this multidimensional risk and say, risk is more than our 5-year trailing standard deviation. That's the whole point of today's talk. If you get nothing else, right? Risk is more than the trailing 5-year standard deviation, right? You have to look at drawdowns, you have to look at scenarios, you have to look at correlation, you have to look at how volatility changes, you have to look at how correlation changes, right? But the more you box risk into one little measure, the more of the total risk picture you're missing, right? And if you're missing part of that risk picture, you could be in for some not so happy surprises. Questions?
Yeah, last year, I believe the Kaufman Foundation wrote a scathing article about venture capital. They invested in a lot of venture capital funds, and they found that nearly all of their returns came from pre-1997 funds, I believe it was, and funds smaller than a few $100 million. Has anyone at Kai or you looking at the VC indexes to find out if there's any statistical biases there?
Right, I'm kind of hinting at that here, right? And that's a very big research issue that I'm just barely hinting at here. But you can see a little bit of that here, right? So the venture capital, this is quarterly data from Cambridge. So you see venture capital has 16% returns with a 28% stated risk, which gives us an equity beta of 0.66. Those are our stated numbers. You delag at just 1 quarter, the volatility goes up to 56%, and the beta goes up to 1.48. So if you're in your CAPM world, right, and your return is actually 15 or 16%, what's the difference in alpha between an equity beta of 0.6 and 1.5? It's a big difference, right? As the beta goes up, the alpha goes down, right? And this is the issue, right? So the question is, would you rather invest in a Russell 2000 small cap index or venture capital with a 10-year lockup and uncertain exits, and you're subject to the IPO markets? So the question you have to ask yourself is, how much return do I need to get from venture capital compared to the return I expect from the public equity index? Some people say 2%, some people say 12%, right? So over this 16-year period, venture was up 16.2, and equities were up 8.3. But the question is, how much do you value your liquidity risk? Yes?
That's my question, is how do you model in some sort of liquidity premium? I mean, I know unsmoothing is one step toward that, but how do we, if we're creating an asset allocation model, put in some sort of risk premium associated with liquidity?
I think a lot of people are interested in that, and I don't think anybody has the answer, right? I think this is one step in this direction, right? So, as I said, if you learn nothing today, right, you learn that 5-year standard deviation is not the only risk measure, right? And so what I'm trying to do is, just like with VIX, right? How many standard deviation points is this skewness and kurtosis exposure worth, right? So when I delag this, right, when I go from a beta of 0.7 to beta 1.5, right, deep down inside, if you ask yourself, do I think that venture has an equity beta of 0.6 or 1.5? I think most of us would be leaning toward the latter. It's probably greater than 1, right? And so then if you say, okay, now I have this beta, right, my alpha goes down. So maybe the difference between the 0.6, the alpha that comes from the 0.6 beta and the alpha that comes from the 1.5 beta, that difference might be kind of pointing you in the direction of what that liquidity premium might be. Right, but nobody's really answered that question yet, and that's obviously an important question that people would like to get their hands around.
Just as a follow-on to that, with the more liquid options available in the alternative space, does that make your job easier to all of a sudden have daily data points?
Oh, yeah. But there's kind of an issue, right? So hedge funds aren't zero risk absolute return products. Hedge funds are some alpha plus a package of a number of betas. And the reason people think they're risk-free is because they might not be taking equity beta risk, right? But they might be taking risk to credit, to volatility, to currency, to commodities, or to short mergers. But I think that a lot of the returns to hedge funds come from liquidity risk and event risk and complexity risk. And as we move into a daily NAV 40 Act world, there's some trading strategies that work just fine in a 1 or 2 year hedge fund lockup with quarterly liquidity that don't work in a daily NAV. And so if you compare the returns of, now we could call them private hedge funds and public hedge funds, if you compare those returns, maybe these statistical distributions will be better behaved. But the question is, once again, how do we value that, right? Are we invested in hedge funds to have some liquid package of public securities? Are we invested in hedge funds to benefit from liquidity risk and complexity risk and event risk? And to the extent that you could take some package of risk or some package of securities in public hedge funds that you can't take in private hedge funds, right? Again, you might have some difference there. So as you go into the 40 Act products and you gain this liquidity, right, as well as easier due diligence and custody and regular accounting statements and all of that, you gain a lot of those benefits. But you would expect that you would have a lower return in the long run because there's some things you could do in the private hedge fund structure that you can't do in the 40 Act structure. But of course, at the end of the day, you have to say, is the value of that package of liquidity risk and complexity risk and event risk, is the value of that package exceeding the difference in the fees between the private and the public hedge funds? So there's a lot of factors that go into that comparison. Any questions about, yeah, Nick?
Well, it's probably not fair. The VIX is great as a tool if you're trying to take something and then make it normal, but in the construction of the VIX, you have all these options that are in the money, right? And it seems if I'm interested in hedging tail risk, it's almost by definition not optimal. But I'm paying a premium for some kinds of things. If I'm worried about something, 10% out of the money, why am I buying something that are in the money? So I know we have this reliance on the VIX, and it makes sense in a lot of ways. But it seems like if there's drag here, then there should be another tool that people come up with in terms of tail risk. Is that?
Yeah. So I have a PhD in VIX, right? And so so I could talk for hours about this, but you're right? So equity volatility is not the only volatility in the world, right? And VIX is a combination of 100 options at a time. Right, and if you were building a tail risk product, you wouldn't buy all 100 options. You'd only buy 3 of them or 5 of them, and so you can deal with that. One thing about VIX you have to be very careful is you never use the VIX index in your asset allocation studies. Right, you use the VIX futures index, right, which has a tremendous amount of contango in it. Right, and so you have to be very careful with the carrying cost in VIX. What people are doing in tail risk products has a lot to do with what we were talking about today. Is that the tail risk products are all about this. The tail risk products are all about non-stationary correlation, right? And so there's been an explosion in assets under management and managed futures, right? So since 2008, managed future space has doubled in assets under management because they were up 8% in October of 2008, and people like that, right? They've proven the value of being up and down markets. And so managed futures assets under management have doubled over the last 5 years. We've also seen a proliferation of these tail hedging funds. And so what a tail hedging fund might do is they'll say, I'm going to buy volatility anywhere in the world in any asset class. So I could buy credit options, I could buy currency options, I could buy commodity options, I could buy equity options, fixed income options, and I'm going to put them all in this basket. And the idea is when the crisis comes, the correlations spike, and what I paid a very low implied volatility for ends up being an equity-like asset, right? So we're thinking a lot about Central and Southern Europe these days, right? And maybe that's where the next contagion comes from. So it was explained to me by one tail hedging manager is that we're buying an awful lot of put options on the Turkish lira currency because the Turkish banking system is encouraging retail investors to reach for yield, and they're buying these structured products from the bank. And what they don't know is that how we get a high yield in a low yield environment is by selling options. And so the citizens of Turkey are routinely selling cheap put options on their home currency. So you could buy Turkish lira options at an 8% volatility. But if we have a European debt crisis, if we have an emerging markets crisis, do you think we could get an equity-like 20-30% drawdown from the Turkish lira? If that's the case, it's all about this non-stationary correlation. So we're going to buy this basket of things that don't look like they're correlated, very low implied volatilities, but if the correlation does spike when we go into a crisis, you have these 30% moves on an 8% vol, which is a lot more fun than a 30% move on a 20% equity vol. Questions on Kaya? Yes.
Does Kaya have a website with a job board or anything like that?
Right, so the website is kaya.org, and on the website you will find any number of useful links, and some people said there's too many videos of me on the site. So you could register for your exam on kaya.org. You can look for material. So if you want to look at the syllabus for level 1 book, if you want to look at the syllabus for the level 2 exam, you could do that online. And there's a job board as well that you could use online there. So and if you have jobs to contribute to the job board, I'm sure your colleagues in the Southern California area would be much obliged. Yes.
And we also are having companies who are now listing Kaya Preferred, and those are in a particular spot in the job board.
I'm sorry, do you have to pay to post jobs? I can't remember. I think so, right? Do you pay to post?
I'm not sure.
I think the employer does.
Okay.
Yeah.
Could you repeat what you just said about the...
Yeah, that we're finding that companies are posting jobs. There is an area for posting jobs with Kaya Preferred. So
That we're going to consider the Kaya candidates first.
yes.
So I was in Seoul, Korea in November, and there's a very senior manager of a pension plan, and they're like many investors, over time they're reducing their reliance on fixed income and domestic equity. They're raising alternatives and they're raising foreign equity. And so the senior manager comes in and he has a Kaya member with him, and he said, I had 10 resumes for this alternatives analyst job, the first person in this pension fund who'll be looking at alternatives, and out of these 10 resumes, only one had Kaya on it, and it kind of explained what it was. I said, well, that kind of makes sense. If we're hiring one person in our pension plan to be dealing with alternatives, it should be this person. And so during the interview, the candidate explains what Kaya is and some of the things he learned in the program. And so he got the job over all these other candidates. And I met with the two of them after he'd been there for probably 9 months. And he said, every single person I ever hire again is going to be a Kaya member, right? And every person who works for me has to take this test. He met one person, right? And he said, this person is so highly qualified to do this job, I want other people to go through the program as well. And that's where the Kaya Preferred comes from. So thank you for coming out. I hope you're not...